Hello, my name is Taylor Pace, and I'm going to be telling you about stock markets around the world. What is the stock market? The stock market is the market in which shares of publicly held companies are issued and traded either through exchanges or over-the-counter markets. Stock markets are one of the most vital components of a free market economy. The stock market gives the public a small slice of ownership in someone's company. Stock markets also give an individual the potential to grow small initial sums of money to large ones and to become wealthy without taking the risk of starting a business. There are at least 20 different stock exchanges around the world, but today I'm going to tell you about 3 of the biggest stock exchanges. The first is the Shanghai Stock Exchange. The second is the Euronext Stock Exchange, and the third is the London Stock Exchange. These 3 stock exchanges are some of the largest in the world and are vital to the global economy. The Shanghai Stock Exchange took a step closer toward the global investing big league last June. The Shanghai Stock Exchange boomed in 2015 and is getting closer to being recognized as a magnet for global capital. A fresh source of overseas demand for Chinese shares is likely due to a fund of $1.7 trillion under the Management Track Index. Over the past year, there were overhauls that have expanded foreigners' willingness to buy and sell Chinese assets and trade in its currency, which is the yuan. Western investors are calling for greater protection as they approach the booming market. A few months later, in October, the Shanghai Stock Exchange started hurting and was about to crash. Thankfully, the Chinese government did not let this happen, and as Chao Deng of the Wall Street Journal writes, the Chinese government, which some analysts estimate has spent hundreds of billions of yen buying stocks to stop the crash, is now left with the market in the doldrums. Shares are close to their lows, and trading volume decreased by 70% from a peak just 4 months ago in June. And volatility has fallen by more than half since July's record. Mr. Hao Hong, who is the managing director at Bank of Communications Company, said, "Low volume, low volatility, and tight trading range are the key reasons the market gets stuck." October 2015 was a tough time for stocks in the Chinese market, so investors decided to shift to other assets. Instead of stocks, investors started buying up bond funds. This made some stock-focused funds change their mandates to be able to invest in both stocks and bonds. Since October of 2015, the stocks were doing all right, but in January of 2016, things just got worse for the Shanghai Composite Index. The Shanghai Composite Index fell more than 5% on January 11th, and many observers think there will be a political fallout for Communist Party leaders. The idea is that Li Keqiang, who is in charge of economic planning, is to blame and will possibly be removed from office. Next, we're going to discuss the Euronext exchange. In the April of 2015 was a great month for stocks in Europe. The stocks climbed to a new record. The Stocks Europe 600 index gained 4.49 points, which is 1.1%. It closed at 409.15, which beat the previous peak of $405.50. The last time the index got that high, it was during the dot-com boom in March of 2000. This rally was fueled by the European Central Bank's efforts to estimate the uninspiring Eurozone economy by buying bonds. Doing this causes bond payouts to be lower, which pushes investors into precarious assets such as equities. While Eurozone economy is showing signs of life, its counterparts, the United States, is slow to recover, which resulted in a surge of investments in the European stock markets. At this time, money managers were favoring European over U.S. stocks in their portfolios by the widest margin since 2007. New York Stock Exchange Euronext, which is the group that operates the European Stock Exchange in New York, was trying to merge with the Deutsche Börse in 2012. The European Union denied the merger in 2012, and in March 2015, the court denied an appeal from Deutsche Börse. The court said the merger would have created a near monopoly for that market because the planned new company would have had a 93% share of such trades. New York Stock Exchange, Euronext, did not make it much longer after the merger got denied. They were bought out by the Intercontinental Exchange Incorporation for $11 billion in late 2013. Die Börse, on the other hand, has prospered as a standalone company, reporting 59% increase in 2014 net profit to $840.9 million. Equity investors at the beginning of this year have had an extremely rough start in 2016. The Central European country called Slovakia is in a group of small stock markets that have made gains this year. This year, Slovakia's minuscule Slovak share index was up 6.4% in February, taking gains for the past 12 months to 36.6%. Analysts say the potential reasons for the increase in the Slovak share index are the Slovakian economy's relative outperformance and the fact that the market is so small. Another reason is the lack of liquidity, because Slovakia does not have the flow of international investors jumping in and out of shares on global themes. Despite whatever the reason is, Slovakia's relatively strong economic growth is expected to continue for now. Next, we're going to discuss the London Stock Exchange. The London Stock Exchange Group, which runs the operations of the London Stock Exchange, are in progressive talks to merge with the Börse. The merger has the potential to happen, and if it does, it would create a dominant European exchange operator and create a rivalry to the big US marketplaces. The British Prime Minister David Cameron set a date for a vote to leave the European Union. 3 days later, the London and Frankfurt-based market operators established discussions to create a business worth more than $28 billion. Regulators' approval of the merger between the two groups would have the London Stock Exchange Group owning 45.6% of the enlarged group, and the Deutsche Börse will own 54.4% of the group. The merger talks are being driven by derivatives, futures, and options that command higher margins because these are harder for rivals to duplicate. The United States has been in strong competition with European exchanges in these markets, and merging will take that pressure off of the European companies. This graph shows what happened when the London Stock Exchange Group announced its merger with the Deutsche Börse. The shares just climbed through the roof. People were investing because they thought it was a really good thing. Xavier Rollet is the CEO of the London Stock Exchange Group, and he hit back at critics on April 6, 2016, denying that a combined group would not pose greater risk to the global financial system. Mr. Rollet said there would be no heightened risk if the two groups' clearinghouses were combined. The clearinghouses are the institutions that process derivatives trades. Customers of the clearinghouses were worried about the amount of collateral that they would have to deposit. Rollet says that the customers misunderstood the impact of the merger on the collateral. The London Stock Exchange projected that the total margin could be reduced if a trade in one clearinghouse is offset against a bet on the other that would tend to move in the opposite direction. The terms of this merger have people worried that the risk would be shifted into the clearinghouses, and the only thing critics can do is see if the merger happens or is denied. In conclusion, stock markets are a vital part to the global economy. When a stock market in one part of the world crashes or gets hurt, the whole world gets hit with the consequences. 3 stock markets that I've discussed in this presentation are the biggest in the world, and if any of them go through a rough patch, the whole world will know. That's it for my presentation, and I will see, and y'all have a good night.